Welcome to this explainer. Today, we're diving straight into something that's honestly one of the most complex, yet totally fascinating mechanisms in international finance. We're talking about the U.S. rate differential adjustment for capital gains and qualified dividends. Now, we're going to be breaking down a highly detailed anonymous expert report that absolutely tears into the math behind cross-border tax parity. We're not doing a surface-level scheme today, no way. We're acting as a specialized analytical engine, dissecting the strict mathematical cause and effect relationships and the implicit assumptions baked into the U.S. tax framework. So if you want to understand the real, under-the-hood mechanics of international tax credit parity at an expert level, you are exactly where you need to be. Okay, let's just get right into it. What is the fundamental systemic conflict that totally distorts international tax credit parity? Well, before we solve the problem, we really need to define it, right? Think about what happens when capital flows across borders. It hits multiple, often totally conflicting sovereign tax systems. To get people to invest locally for the long haul, tax systems, like in the US, often dangle a carrot. They offer special, lower tax rates for specific types of investment income. But at the exact same time, they're trying to offer credits for taxes paid to foreign governments. So how on earth does a domestic preferential rate throw a wrench into the mathematical balance of an international tax credit? Let's break down exactly why this structural distortion happens. Section 1, the preferential tax asymmetry. To really get why this adjustment exists, we first have to look at the core asymmetry and how different types of income are treated. The report points out that passive income, things like capital gains and qualified dividends, gets preferential, lower tax treatment compared to your standard ordinary income. The statutory framework does this on purpose, you know? It's designed to prevent capital flight and incentivize holding onto assets. On one hand, you have ordinary income facing those standard higher statutory tax brackets, like what you'd see on normal wages or business profits. But then on the other hand, you have this completely different paradigm. Preferential passive income rates are intentionally slashed lower. And boom, right there, this dual rate structure creates a massive systemic asymmetry in the tax code. We aren't dealing with a flat, uniform system anymore. We're dealing with a tiered beast where different revenue streams carry fundamentally different tax burdens. And this is exactly where the problem blows up. Without some kind of mathematical intervention, this asymmetry basically hands taxpayers a massive loophole. It allows them to artificially leverage foreign tax credits against lower-taxed domestic income. Think about it. If you pay a massive amount of tax in a foreign country on a capital gain, but that exact same gain is barely taxed back home because of a preferential rate, well, applying a simple dollar-for-dollar credit would be disastrous. You could essentially take those excess foreign tax credits from lower-taxed income and just wipe out your domestic tax liabilities on higher-taxed ordinary income. It completely wrecks the integrity of the cross-border calculation. So the system desperately needs a mathematical intervention to stop this artificial inflation of allowable credits. Moving on to Section 2, fractional equivalency logic. Now that we know the problem, let's look at the fascinating mathematical equivalency experts use to actually fix it. According to the analysis, this is where the rate differential adjustment steps in. And make no mistake, this isn't just some loose policy guideline. It is a hard, strict mathematical algorithm. By applying this adjustment to foreign-sourced capital gains and qualified dividends, the system forcibly restricts the fractional allowance of that income. The whole goal? To artificially synthesize parity. It effectively neutralizes the preferential rate advantage for foreign tax credit purposes. Look, if the rate is lower, the absolute only way to treat it equally alongside standard income in a unified calculation is to literally shrink the principal amount you're calculating. Let's look at the exact math on how this plays out. So, here is the absolutely crucial takeaway. Taxing a capital gain at a lower preferential rate is mathematically identical to taxing a much smaller specific fraction of that gain at the highest standard rate. Let's say you have a $10,000 gain taxed at a preferential 15% rate. That gives you a $1,500 tax liability, right? Now, take a much smaller gain, say $4,054. but tax it at the highest standard statutory rate, which is 37%. Guess what? The resulting tax liability is exactly the same, $1,500. That smaller number represents the theoretically fully taxed equivalent. By actually shrinking the dollar amount of the gain being reported, the system can safely plug that smaller number into standard limitation calculations without blowing the doors off and creating a loophole. The real-world effect of this adjustment is that only the theoretically fully taxed fraction of your capital gains is actually allowed into the final limitation calculation. Visualizing this bottleneck really makes it click. Imagine your total gross capital gain is a whole pie, but because you're getting a preferential tax rate, a huge slice of that pie, what we call the excluded preferential variance, has to be completely stripped away for international credit purposes. Only the remaining slice, that theoretically fully taxed fraction, is allowed to pass through the regulatory gates. It's an ingenious way to guarantee that the foreign tax credit limitation is calculated using an apples-to-apples baseline of income weight. Section 3. The rate differential mechanism. Theory is great and all, but actually executing this requires some incredibly strict enforcement. The mechanism dictates in no uncertain terms that foreign-sourced taxable income cannot just absorb your full capital gain. It can only absorb the adjusted net income fraction. The expert report really hammers home the word "only" here. This is a totally non-negotiable boundary condition. When someone is tallying up their foreign-source taxable income to figure out how much credit they can legally claim, they are straight up legally barred from using the gross amount of their capital asset sales. They have to use the post-adjustment net fraction. This is the exact legal bottleneck that stops you from cross-crediting those high foreign taxes against low-taxed domestic passive income. Section 4, Decimal Ratio Application. So how do we actually operationalize this? Well, official regulatory guidance requires a highly specific sequence of actions. By executing these precise steps, the asset's taxable weight is accurately reduced. The analytical insight here is just how incredibly rigid and procedural this adjustment really is. First, you have to accurately classify the income. Like, is it a short-term gain, long-term, a qualified dividend? Then you have to track down the exact statutory decimal multiplier. And fun fact, in the US system, this decimal multiplier dynamically changes depending on the current corporate or individual top marginal tax rate versus the preferential rate. It's a moving target. Finally, you actually execute the math by multiplying the gross gain by that decimal. It's just a wonderfully elegant, even if super complex, mathematical translation. Experts also highlight some totally critical, non-obvious details here. Namely, this adjustment is mandatory regardless of your overall tax bracket, and it applies equally to qualified dividends. This is a massive actionable insight. A really common misconception out there is that if a taxpayer's overall income is just sky high, pushing them into the absolute maximum standard tax bracket, they might just magically be exempt from this granular adjustment. While the expert report is crystal clear, they are absolutely not. The adjustment is tied to the intrinsic DNA of the income itself, not how wealthy the taxpayer is overall. Plus, since U.S. qualified dividends share that exact same preferential tax DNA as capital gains, they get hit with the exact same rigorous fractional reduction. Section 5. Alternative tax variances. As we near the end, we've got to examine the boundary conditions when dealing with parallel alternative calculations. This brings up a pretty vital question for anyone managing complex portfolios. What happens when alternative minimum tax rules are triggered? A lot of systems, including the US, use a parallel minimum tax structure, known as the Alternative Minimum Tax, or AMT. The whole point of AMT is to make sure high net worth entities can't just cleverly use standard deductions to drop their tax liability down to zero. But when an entity gets forced into this alternative framework, their baseline tax rates shift. So, does our neat little fractional equivalency logic still hold up? How does the adjustment actually survive when the very foundation of the math shifts beneath it? Well, the report definitively states that a completely separate parallel calculation paradigm has to be executed to satisfy these alternative limitations. You can't just be lazy and carry over the decimal multipliers from your standard calculation. Nope, because the US alternative minimum tax uses a totally different set of statutory rates, usually with a much tighter spread between ordinary and preferential rates. The mathematical ratio between the two fundamentally changes. Because of this, an expert practitioner literally has to run a completely independent parallel set of fractional adjustments just for the alternative minimum calculation. It is honestly a stunning layer of required complexity just to maintain cross-border parity. To wrap up this explainer, I want to leave you with a final, slightly provocative thought. As global tax rates constantly shift, how fragile is the math actually holding this cross-border parity together? Think about it. This entire rate differential adjustment relies entirely on the precise mathematical ratio between a specific domestic preferential rate and a specific highest statutory rate. The second legislation changes just one of those numbers, boom, every single decimal multiplier, every fractional equivalence, and the entire boundary condition of the international credit limitation is instantly, completely altered. It really highlights a profound vulnerability in international finance. Global parity is entirely at the mercy of localized US domestic rate volatility. Thank you so much for joining me on this deep analytical dive today. Keep questioning the math and always keep looking for the mechanisms hiding beneath the surface.